There's an indicator that has predicted every single recession since 1950. Not most of them, every single one. Exposed the 1973 oil crisis before it happened. Called the 1980 double-dip recession. Warned about 2001 months before the dot-com collapse finished. Flashed red in 2006, 2 full years before Lehman Brothers went bankrupt. Exposed the 2020 crash weeks before COVID was even a headline. Its track record is perfect, every time. No false positives in over 70 years. The Federal Reserve knows about this indicator. Wall Street watches it religiously. But for some reason, it never makes the evening news. They never teach it in school. And right now, this indicator isn't just flashing a warning, it's screaming one. The signal triggered in 2023, and if history holds, what comes next won't be pretty. The indicator I'm talking about is called the yield curve. Specifically, the spread between the 10-year Treasury yield and the 2-year Treasury yield. And before you click away, because that sounds complicated, give me 60 seconds. Because once you understand what this is, you'll see the economy completely differently. And you'll wonder why nobody told you sooner. Here's the simple version. When you lend someone money for a longer period of time, you should demand a higher interest rate. That's common sense. If I lend you money for 3 months, I'll charge you less than if I lend you money for 10 years. More time means more risk. More things can go wrong, so you want more reward. The government borrows money by issuing treasury bonds. 2-year bonds, 10-year bonds, 30-year bonds. Different lengths, different interest rates. Under normal conditions, longer bonds pay higher interest rates than shorter bonds. That's called a normal yield curve, but sometimes something strange happens. Sometimes short-term rates rise above long-term rates. The 2-year Treasury starts paying more than the 10-year Treasury. That's called an inverted yield curve. And when the yield curve inverts, recession follows. Always. Let me show you why this matters. The yield curve inverts when investors believe the future is going to be worse than the present. Think about it. If you thought the economy was going to be booming in 10 years, you'd demand a high interest rate to lock your money up that long. You'd want to be compensated for missing out on all those opportunities. But if you think the economy is going to be struggling in 10 years, if you think growth is going to slow down and interest rates are going to fall, then you're actually happy to lock in today's rates for the long term. You accept a lower rate on the 10-year because you think it is the best you're going to get. When millions of investors make this calculation simultaneously, the yield curve inverts. It's the bond market voting on the future. And the bond market is a lot smarter than the stock market. Stock investors get excited. They chase momentum. They buy things because prices are going up. The stock market can stay irrational for years. Bond investors are different. They're institutional. They're calculating. They don't care about stories or hype. They care about getting their money back with interest. When bond investors start pricing in a recession, you should listen. Now let me walk you through the exposed record. In 1969, the yield curve inverted. The recession of 1970 followed within months. In 1973, the yield curve inverted. The brutal recession of 1973 to 1975 followed. The stock market fell almost 50%. Exposed it? In 1978, the yield curve inverted. The 1980 recession followed. Then it inverted again in 1980, and the double-dip recession of 1981 to 1982 followed. The worst economic downturn since the Great Depression at that point. Exposed it twice. In 1989, the yield curve inverted. The 1990 recession followed. Exposed it. In 2000, the yield curve inverted. The 2001 recession and dot-com crash followed. Exposed it. In 2006, the yield curve inverted. Most people ignored it. The housing market was booming. Stocks were at all-time highs. CNBC was celebrating. 2 years later, Lehman Brothers collapsed and the global financial system nearly ended. Exposed it 2 years early. In 2019, the yield curve inverted. People debated whether it still mattered. Maybe this time was different. Then COVID hit in 2020, the economy collapsed, and we entered a recession. Now you can argue COVID was a black swan nobody could have predicted. But the yield curve didn't know COVID was coming. It just knew something was wrong. It sensed the fragility, exposed it every single time. No misses, no false alarms. Some people will tell you there have been false positives. They'll point to minor inversions that didn't lead to immediate recessions. But when you look at the exposed data, every significant inversion, every inversion that lasted more than a few days, has been followed by a recession within 6 to 24 months. 100% accuracy over 74 years. Find me another indicator with that track record. You can't. So what happened recently? In July 2022, the yield curve inverted. The 2-year Treasury yield rose above the 10-year yield for the first time since 2019. And it didn't just invert briefly, it stayed inverted. For months, then for over a year. It became the longest and deepest inversion since the 1980s. At its peak, the 2-year was yielding almost a full percentage point more than the 10-year. That's not a mild warning, that's a screaming alarm. And here's where it gets really interesting. The yield curve inverting is the warning. But the recession doesn't usually start while the curve is inverted. The recession starts after the curve uninverts, after it goes back to normal. This is the part most people miss. When the curve is inverted, it means trouble is coming. When the curve uninverts, it means trouble is here. Think about why this happens. The curve uninverts when the Federal Reserve starts cutting short-term rates, and the Fed cuts rates when they see the economy weakening. So the uninversion is actually the moment when the slowdown becomes undeniable. It's when the Fed panics. In 2007, the curve uninverted in the summer. The recession officially started in December 2007. Lehman collapsed in September 2008. In 2001, the curve uninverted in early 2001. The recession started in March 2001. In 1990, the curve uninverted in early 1990. The recession started in July 1990. The pattern is consistent. Inversion is the warning. Uninversion is the trigger. Now here's what's happening right now. The yield curve that inverted in 2022 started uninverting in late 2024. After being inverted for over 2 years, the longest inversion on record, it's finally normalizing. If the historical pattern holds, this means we're entering the danger zone right now. Not a year from now, not 2 years from now. Now, the clock has started. But here's what makes this time potentially worse than previous cycles. The depth and duration of this inversion was extreme. It wasn't a mild inversion like 1998, which some people argue was a false signal. This was a deep, sustained, historic inversion. The bond market spent over 2 years screaming that something is very wrong, and the conditions supporting the economy right now are artificial. Government deficit spending is running at levels we've never seen outside of World War II. Trillions of dollars being pumped into the economy every year. That spending has masked weakness in the private sector. It's created an illusion of stability, but deficit spending can't continue forever. The interest payments on the national debt are now larger than the defense budget. We are approaching a point where we're borrowing money just to pay interest on the money we already borrowed. That's a debt spiral. When the government is eventually forced to cut back, whether by choice or by market pressure, that artificial support disappears, and the underlying weakness gets exposed. Meanwhile, the consumer is running out of gas. Credit card debt has exploded to over $1 trillion. Delinquency rates are rising. The excess savings from COVID stimulus checks are gone. People are surviving on borrowed money and borrowed time. The labor market, which has been the one bright spot, is starting to crack. Job openings are declining. Hiring is slowing. The unemployment rate has ticked up from its lows. None of this is showing up in the stock market yet. Stocks are near all-time highs. The AI boom has created a frenzy that's masking what's happening underneath. But the bond market sees it. The yield curve sees it. And the yield curve has never been wrong. Now, I want to address the skeptics, because every time the yield curve inverts, the same people come out and say the same things. They say this time is different. They said it in 2006. They said it in 2019. They're saying it now. Their argument usually goes something like this. The yield curve inverted because of technical factors. The Fed's quantitative easing distorted the bond market. Foreign buyers pushed down long-term rates artificially. The signal doesn't mean what it used to mean. I've heard all of these arguments, and I understand why smart people make them. Nobody wants to believe a recession is coming. Recessions are painful. They cost people their jobs, their homes, their savings. It's more comfortable to explain away the warning signs. But here's the problem. People made these exact arguments before 2008. They said the inversion was caused by a global savings glut. They said foreign demand for treasuries was distorting the signal. They said the Fed had the tools to engineer a soft landing. They were wrong. The recession came anyway. The yield curve was right. People made the same arguments before 2020. The inversion was brief. Maybe it didn't count. The economy was strong. Unemployment was low. They were wrong. The recession came anyway. The yield curve was right. At some point, you have to respect the data. 74 years, every recession. No misses. That's not a coincidence. That's a signal. The other thing skeptics say is that even if a recession is coming, so what? Recessions are normal. They're part of the business cycle. The economy recovers. Stocks come back. Just stay invested and you'll be fine. And there's some truth to that. If you have a 30-year time horizon and you don't need your money, you can ride out any recession. History shows that markets recover eventually. But that advice ignores something important. Not everyone has 30 years. Not everyone can afford to watch their portfolio drop 50% and wait a decade to recover. People retire. People lose jobs. People have expenses that can't wait. And more importantly, the advice to just stay invested assumes every recession is like the ones we've seen before. What if this one is different? What if the combination of record debt, artificial stimulus, geopolitical instability, and a banking system that almost collapsed in 2023 creates something worse than a normal recession? I'm not predicting a depression, but I'm not ruling it out either, and neither should you. The point of understanding the yield curve isn't to panic, it's to prepare. When Roger Babson warned about the 1929 crash, He didn't tell people to sell everything and hide in a bunker. He told them to reduce risk, hold more cash, own assets that would hold value in a downturn, be positioned to survive, and then thrive when the opportunity came. That's what the yield curve signal allows you to do. It doesn't tell you exactly when the recession will hit. It tells you that conditions are ripe, that the probability is elevated, that now is the time to check your exposure. How much of your net worth is in stocks? How much of that is in speculative assets that could drop 70 or 80%? How much cash do you have access to if you lose your job or face an emergency? How secure is your income? These aren't fun questions to ask, but they're necessary questions. The people who got destroyed in 2008 weren't stupid. Many of them were sophisticated investors. They just didn't take the warning signs seriously. They assumed someone would tell them when to worry. They assumed the experts had it under control. Nobody told them. The experts didn't have it under control. And by the time it was obvious, it was too late to protect themselves. You're getting the warning now. The same warning the bond market has given before every recession since Eisenhower. The signal with a perfect track record. What you do with that warning is up to you. You can dismiss it. You can tell yourself this time is different. You can trust that the Fed will engineer a soft landing. Or you can respect the signal that has never been wrong. You can acknowledge that maybe, just maybe, the smartest investors in the world are seeing something that the stock market and the financial media are ignoring. The yield curve inverted in 2022. It stayed inverted longer than any time in history. It's now uninverting, which historically marks the beginning of the recession window. We're inside that window right now. Maybe I'm wrong. Maybe this really is the first time in 74 years that the signal fails. Maybe we get a soft landing and everything is fine. But if I'm right, the next 12 to 18 months are going to be painful for a lot of people. The people who prepared will survive. The people who didn't will suffer. History doesn't repeat exactly, but it rhymes. And right now, the rhyme is getting very loud. The indicator has spoken. Every recession since 1950. No exceptions. Now you know. What you do next is up to you. Also, I want to thank all the members of this channel. Thank you for all the support and for helping this community grow into something powerful. For those who are new, if you're getting value from this content and want to support the channel, you can join the elite members by clicking the Join button. Here's the thing. I don't promote scam products. I don't take money from sketchy sponsors to push garbage on you. The membership is what allows me to stay independent and focused on giving you the best information possible without compromising or selling out. You'll get access to exclusive members-only content that goes way beyond what I can share publicly on YouTube. Advanced research, deeper dives, real-time updates that I simply can't put